Good morning. Welcome to Bazaar Morning Call. I'm Lata, with me Anuj and Reema. Well, we have a lot of missing anchors today, it being a lonely Friday and, of course, people falling sick with the weather change. But, well, we are going to play a lot of these creme de la creme of Indian business as they sat in judgment of other businessmen at the CNBC TV18 India Business Leader Awards. But that celebration for another moment, for the moment, the markets are not in celebratory mood. And I'm not making any bearish statement by saying that the global cues are now worrying about growth. That's what the Wall Street indices have been worrying over the 2 days, the day we didn't trade and overnight, that the Fed's tightening cycle, the Fed minutes are indicating that the growth cap perhaps cannot go on at the pace it did. As well, the Chinese GDP undershooting expectations and leading to the red on Asian screens as well. But for me, I think the bigger worry, or as much of a worry, is the domestic debt problem. Now, the connection between realty companies, housing finance companies and NBFCs is what worried the market on Friday. One downgrade of one realty company, of one bank facility of a realty company, and there was complete, sellout in all the housing finance companies. Now, we have got some numbers. The Credit Suisse report indicates that there is 5 trillion of loans to realty companies. 21% of the loans given by NBFCs and HFCs is an exposure to realty companies. Now, how much, who has, and who will be the next shoe to drop, the market doesn't know. And when it doesn't know, it will want to get away from those sectors. So my big fear is that the sell-off we saw on Wednesday is perhaps not the last of the sell-off in these sectors.
And that is what precipitated the big fall in Wednesday's trade as well. So that was a disappointing session. In case you've forgotten, after the holiday, the markets had started off strong, but they reversed gains. And finally, the Sensex was down about 900 points from its top. Now, if you look at the cues today, the Nifty futures closed at 10,400 on Wednesday's trade. The SGX Nifty somewhere around the 10,300, 320 mark, which means the SGX Nifty is actually suggesting a cut of close to about 120, 140 points today. The level to watch will be the Nifty low last week, which is 10,138. But to clutch at a few straws in the way up, the FIIs were buyers in the cash market, at least in Wednesday's trade. So they bought about 140 crore. That said, they've still sold close to about 18.5, 19,000 crore rupees so far in October. But on the flip side, the DIIs have turned sellers for the first time in the month of October. So the DI sold about 350 crore in the cash market. And apart from that, Lata, Brent crude prices have dipped below that $80 per barrel mark. And if you compare it to the high last week, it was 86.7. There is a bit of a, tailwind which we could see on account of the decline in crude prices. But Anuj, at least the SGX Nifty is suggesting that the turmoil may continue in today's trade. On Wednesday, I remember you saying that perhaps it was a good time to go short. Now, considering that we fell quite a bit in Wednesday's trade, at least in the morning today, we could see another sell-off. Do you think the markets may put a near-term bottom today, at least in the beginning, and therefore it may make sense to go long?
Morning, Reema. For me, it's all about risk-reward. And on Wednesday, the issue was very clear. It was a market which had entered as, sort of a near-term euphoria, and crude was back to higher levels. So it was a good risk-reward to take short. I think today is the best risk-reward to try a long trade. Today is a day where you would see. In fact, the SGX Nifty is already recovered. If it had not, perhaps it would have been a better trade. But the Nifty lost 250 points from highs on Wednesday. Let's not forget that. And if the SGX Nifty is right, make that 400 points from top of Wednesday's opening. So for near-term traders, it's basically about risk-reward. The risk-reward did not favor a long trade on Wednesday. The risk-reward does not favor a short trade today, at least at the open. You want to see where the market goes. I think let's just see the template of, I think, last Thursday, or it was the previous Thursday, when we had the big decline in the US market, and our market just somehow didn't fall as much, because we are actually very sensitive to crude. The reason we talk about crude when it goes up, we should talk about that on the way down as well. Below $80 per barrel for crude, I think that's a big positive. That will prevent a big fall for Indian market. I take the point that there's going to be a bit of a mess in NBFCs, and that's one area that I've been saying for last many weeks now, that stay clear of at least the housing finance companies. There are select NBFCs where this fall might be presenting a good opportunity, but housing finance is a strict no-no. And I just think about it. If NBFCs are in such a mess, if PSU banks are in such a mess, then who gains? Ultimately, the stronger private sector banks, the likes of HDFC Bank, the likes of Kotak Mahindra Bank. And these are the stocks which actually have the highest weight in the index. So somewhere you are getting a decent opportunity. Also, on Wednesday, HDFC Bank, the way it fell between 3 to 330 was purely a weekly options expiry play. On Wednesday, you had one of those expiries where 1 rupee option became 100, 150, then the next 1 rupee option became 100, 150. Those are kind of waterfall declines, and next day normally you see recovery in stocks like HDFC Bank at least. So that's perhaps going to keep the market in good stead. Quite a long story short, I think just see the first hour. The market will give you enough indication that whether it wants to fall or not. My sense is today you latch on to crude and the fact that there was no aggressive selling by FIIs on Wednesday. So if with the low of the day sort of stop, perhaps you may want to try a long trade today.
No, I am not at all speaking about the trade for today and tomorrow, but I think there is a long pain ahead for realty companies. Their exposure to housing finance companies and to NBFCs is a pain that won't go away quickly. And that takes its toll on a penumbra of industries. The obvious beneficiaries, and I would put even PSU banks in that. PSU banks have been beaten down enough, and therefore they will be beneficiaries of, the space lying vacant by, or vacated by the NBFCs, and more importantly, the housing finance companies. They have the reach, and housing finance companies, it's not difficult to make housing finance loans. So it's not... it's not affordable housing that gets hit. It's not home loans that will get hit, but it will be realty company loans that get hit. So that's another sector we have to worry about. That pain will be there for some time now. One Credit Suisse report says that it's a 5 trillion rupees, that is 5 lakh crore exposure of the top 70 companies. So that's not a small amount. The markets will have to get used to it.
Okay, we'll discuss these themes with our experts on the show. Let's first tell you what our wise experts have to say going into trade this morning. It's Chris Wood of CLSA who says there is hope of renewed outperformance by Asia and emerging markets, mostly if the US dollar peaks out. But for that to happen, in Greed and Fear's view, it requires confirmation that the Fed tightening cycle is ending, and this is not yet in sight. Still, Donald Trump's slightly more vociferous optimism of the Fed over the past week has put one dent in the US dollar.
Okay, money market views. Bhaskar Panda of HDFC Bank says a plethora of events, including fall in US stock markets, widening US-Saudi rift, ongoing US-China trade war, and most importantly, suggestion of further rate hikes in the US are in focus. In the midst of all this, dollar index is holding up around 95, almost 96. In India, worries about local and global factors prevail. Given this background, Bhaskar says the USD-INR pair might start consolidating around the 73.50 pivot. He expects the rupee to trade in a range between 73.65 to 73.65 against the dollar. Today, I think there is currency weakness because the dollar strength is quite evident across Asia and overnight across emerging markets.
Okay, on the bond markets then, Bhaskar Panda of HDFC Bank says as far as the Indian benchmark yields are concerned, they seem to have found a temporary base. Hence, he expects the 10-year benchmark bond yield to trade within a range of 7.9 to 7.95% for the day.
Okay, let's talk about the global cues then. They look quite bad this morning. Here's Mangalam with the world view.
Well, weakness across Wall Street as well as Europe and the Asian markets, no two ways about it. In yesterday's trading session, we saw a near 300-point decline on the Dow Jones, 1.5%, as well as 2% shaved off NASDAQ as well as S&P 500. For the month itself, the Dow Jones as well as S&P down 4%, the NASDAQ down about 7%. A couple of fears plaguing the U.S. markets, the U.S.-China trade war, fear of rising interest rates, and perhaps some overvaluation in tech stocks. That was seen in the way Apple Apple reacted yesterday. The stock was down about 2.5% after the company, informed the exchanges or informed the street that they will launch new products on October 30th. Usually, Apple rises on such announcements. So, 2 new products which we cannot afford. Across the Atlantic, sharp cuts across the European indices, Brexit worries as well as Italian budget worries taking some money off the European index as well, or European markets too. Emerging markets, 2% cuts on both Russia as well as Brazil. Come back to Asia, Nikkei, Hang Seng, Kospi as well as the Shanghai index, all of them lower anywhere between 0.3% to 1%. SGX Nifty too indicates a lower start as against Wednesday's futures close, though it is off the lows.
Okay, that's good to hear. Off the lows, and off the lows by a distance. I mean, it was almost a 100-point cut and now a 56-point cut. So let's see how things pan out. To be fair, SGX Nifty has not been a very fair indicator of how the day pans out. It might give us some indication of how the day begins, but it has not quite been able to tell us how the rest of the day progresses. But we have an important macro, or several important macro cues as well. The US dollar index itself is at 96. The Fed minutes are indicating that the US Fed is in no mood to change its rate hiking cycle. And of course, now we have the Chinese data, all that keeping emerging market currencies under pressure. Samir Goel, head of Asia macro strategy at Deutsche Bank, joins us on the phone line. Samir, thank you very much for joining us. Always good to have you with us. Do you think the pain for emerging market currencies is now going to continue with this renewed China negative news and Fed hawkishness?
Morning, Lata, and thank you for having me on. Yes, indeed. I mean, as you know, it's been our view for a little while that a lot of the headwinds for emerging markets are still very much on, and that will continue to pose a pressure and at least keep markets terribly volatile. As you said, a lot of macro events happening at the moment. We see what's happening with on the oil front. We certainly are seeing the trade narrative at the very minimum being very volatile, but arguably only worsening here. We are seeing greater macro noise coming out of Europe. And of course, then, as you said, on the China front, as both the dollar China and the TWI, the CFED's basket in China, approaching pretty key levels, it's clearly creating more macro stress across the entire complex.
Samir, good morning. For the rupee per se, you've got 2 macros which are at play. So one, we've got a positive current account deficit number which came through, the trade deficit number, I'm sorry, for the prior month. But on the flip side, we've seen crude prices retreat quite a bit, now below that $80 per barrel mark for Brent. How would these 2 factors play on the rupee per se and the range that you're working with?
Yes, for sure. Some of the recent news, at least on the margin, has been positive in that the trade gap and the basic balances more generally has been the basis for a lot of the weakness in the currency, a lot of the bearishness on the currency. But do remember that the global dynamics still remain fairly punitive. The Indian trade dynamics are subject not just to oil prices, but also in some sense to the broader trade and sort of the RMB dynamic, in that a large part of the trade gap is also coming because of electronics imports. So I think it's very hard for this narrative to turn sharply without corresponding tailwinds from the global picture as well. So I think it gives some relief here, but to our mind, the adjustment in the rupee to the underlying situation on basic balances, and of course to the challenges about financing the same, given the tightening in global monetary conditions, and as the Fed continues to hike, which in our opinion it will for the next 4 or 5 quarters, I think it will still present a challenging situation. I think the adjustment in the rupee is not yet complete.
Okay, so I mean, there were a lot of people looking at the rupee as between 73.50, 74.50. You're not so sanguine?
I think in the near term, as I said, I mean, we could see some better support for the rupee here, but to our mind, the adjustment will probably, and we have held that target for a while, would probably take us closer to 75 on dollar rupee, in our opinion. In fact, the way the macro environment is moving, it's also possible that there are temporary overshoots, which happen maybe because of weakness in personal asset markets or as the macro situation evolves. But to our mind, our target on dollar rupee has been 75.
Okay. How do you see the US yields and the dollar index playing out? More strength?
See, the dollar here is it's interesting. I think there are $2 we are talking about here. The dollar index in itself refers primarily to dollar versus G10, and our view for a little while has been that a lot of the increase in the dollar index, so the dollar G10 we have seen, has largely been because of a combination of events where you've seen yields rise, but in general, U.S. assets doing fairly well because the monetary conditions, the financial conditions have been fairly easy. Now, I don't think that combination can repeat itself necessarily next year. So we are a little bit more neutral, more sanguine as far as the dollar G10 index is concerned. Dollar EM, on the other hand, as I spoke about earlier, I think continues to face a lot of headwinds, whether it is from tightening in U.S. yields, whether it is from the trade narrative, whether it is from higher oil prices. So I think that will continue. U.S. yields, our opinion is that the Fed continues to tighten rates. And in fact, if anything, we are increasingly concerned about increased term premium in the curve, which comes as a result of end of sort of pension fund rebalancing and as the global QE demand flows for U.S. Treasuries also tapers off. So we do think the curve can actually start to steepen up.
No, so what are you looking at? But in 2018 itself, does the index go to, does the 10-year yield go to what, 3.3? I mean, does it even cross the three-quarter that it has shown us past week?
Yes, we do think there is a good chance that by the end of the year, given that we do expect the Fed to again hike rates in December, that yields will be higher. Our forecast ultimately, we see U.S. 10-year yields topping out by about third quarter of next year at about 3.6%.
The 10-year, 3.6. Okay, so your basic thesis is that more money continues to flow out of Asian, or for that matter, Indian equities and bonds?
It's interesting. The flow picture for Asia is obviously been very poor, but has been very largely skewed by equity outflows as against fixed income. India is a little different because India has suffered a lot of debt outflows as well. But typically, debt outflows tend to be very sensitive to the slope of the curve. So I think what becomes very critical for the flow picture here is one, of course, what happens to the growth cycle, which the equity flows are very sensitive to. But for fixed income flows, I think what becomes critical is how much steeper the global fixed income curves actually get. So if you do get more term premium, then I think the flows can still be in pressure for the next few months.
Okay, that's not looking very good. Thank you very much, Samir Goel, for joining us with your perspective of so many global cues that at the moment are not looking terribly Indian equity positive, or for that matter, even Indian debt positive.
Yes, the US 10-year yield, 3.6%. The rupee could be headed to 75. In fact, a quick recap then of the global macros. Remember, the US dollar index is hovering around that 96 mark, trading at close to a one-week high. Treasury yields are trading at near multi-year highs after the minutes from the latest Fed Reserve September meeting showed that Fed policymakers are largely united on the need to raise borrowing costs further. CNBC's Sarah Eisen spoke exclusively to the former Fed Vice Chairman Stanley Fischer, who says it is not the time for the Fed to pause.
I don't think the Fed should be taking a pause right now, but it's a year since I left the Fed and things happen. The economy actually seems to be doing even better than we expected it would a year ago. And I trust their judgment. They're a very good bunch of people. It's a sort of global problem. Every country you go to can't understand why inflation is low. Listening to other countries, they think that it's competition from lower income countries that is keeping wages down. And that's a possibility, but we don't really know. And it's something we watch all the time. Could have something to do with the lower productivity growth that we have now than that we would have had at a similar stage of the business cycle 20 years ago. So that could be another factor. But it's simply a problem that's got to be understood, and it isn't fully understood. Well, there's one big threat on the horizon, and that's the trade war, which we may or may not have with China. This is not something, I mean, the president said trade wars are great, you could win them easily. Well, I don't think he knows what a big trade war is about. He's not playing with Canada now. He's playing with China, which is very important in the global economy and important for us. So it's going to be a harder game to play, and yeah, it worries me. We've seen that when the market has, in recent weeks, sort of begun to worry a little bit and the market goes down for a few days, then everybody starts thinking that the game is over. At some point, the economy will not grow at this speed. This is faster than it can sustain. And I always say, we, the central bankers, cut interest rates severely to encourage growth and to support equity prices.
Okay, by the way, there is a recovery underway in the Asian markets. So the Chinese markets as well as the Hong Kong index has seen a recovery of 1.5% from the lows, absolutely flat now. In fact, the Chinese index has now got back into the green territory again of close to about 0.3%. And this is despite their Q3 GDP missing expectations coming in at the lowest level since 2009. China has shrugged off that news and it's seen a recovery. SGX Nifty is still down, though that too is seen a bit of a pullback from its earlier levels. It has to play catch up to our markets being shut yesterday. We'll slip into a short break. On the other side, our list of the top 10 stocks that you need to watch out for this Friday. Stay tuned.